This is kind of a end of year post-Fed update to the markets. If you haven't met me before, my name is Steve Villamac. I'm a partner with Hightower Great Lakes in the Chicago office. Joining me is Don Stellan, who's also a partner in our Traverse City office. And our special guest is Stephanie Link, who's Hightower's Chief Investment Strategist. So she's both very active and a very successful portfolio manager. She speaks frequently at our industry events, but where our clients may see her the most is as a CNBC contributor. Stephanie's on TV quite frequently, answering questions about the market in general, different themes. So I think we're very fortunate to have you at this time. We appreciate your time, the day after the big Fed announcement. So we'll get started there. I think just a little bit of background for the clients. I know it's been a volatile 2020. We knew coming into the year the Fed was going to raise rates, and when that happens, there's usually some volatility. But I think the lingering effects of COVID on inventory, longer inflation than we probably would have liked, geopolitical stress has all led, even I think long-term patient investors to feel a little uncertainty at this point in time. So I think it's the market kind of sold off in March, came back nicely. We hit the year-to-date lows in June, and we had a nice run back again. And then what we're feeling kind of the last month and a half or so leading to this meeting yesterday, I think, was uncertainty over kind of the Fed's direction going forward. So why don't we start with that, Stephanie? I'd be interested in your thoughts on kind of Jerome Powell's, the announcement that the Fed made, and then maybe what you think their actions are, maybe what they both communicated, and maybe what their options are late towards the end of this year.
Sure. And Steve, thank you for having me, and Don, and welcome to all the wonderful clients that you have. It has been a tough year. The S&P 500 right now is down 21% year to date, and fixed income is also down double digits year to date. I think people expect that markets are volatile and you can have good years and bad years, and you can lose money, but you can make a lot of money too, as was the case the last 3 years. The S&P 500 had a compound annual growth rate of 28%. And I think people kind of forgot that you could have years like this one. So it hurts all the more. But I think what's more surprising for clients is that I think people forgot you could lose money in fixed income as well. And so unfortunately, we're getting this double whammy. And I'll get to the Fed, but I think what is the reasoning behind all of this? You summed it up pretty well. There's a lot of unknowns, right? And it's been a lot of unknowns all year long. And while the market doesn't like unknowns, I always say that the market always climbs a wall of worry. I actually worry when we don't worry, because it means that you're complacent. But we have some unknowns in spades this year, and it's just after coming off of a couple of years that were well above average. Why did we see well above average? Well, it's because we put an unprecedented amount of stimulus in the system, both from the government on the fiscal side and both from the Fed on the monetary side. In fact, if you add the two together, and in terms of the stimulus that was put in place at the peak, it was 60% of US GDP. That compares to our last like if you say crisis in 2008, when if you added up the fiscal and the monetary policies put in place, it was 5%. So we put an enormous amount of liquidity in place over the last several years. And why did we do it? Because we closed the country down. The world shut down. It needed to. It needed to have this liquidity to get back up and running. And as of course, there is a lag impact. When you put stimulus into the system, it takes a year to feel it in the economy. And so we had a couple of good years, even though it didn't feel so good because we were in the thralls of COVID. But that's the reason why we did so well from a recovery point of view and from a market point of view. Well, fast forward this year, it's the exact opposite. We have less fiscal. We've seen a couple of programs, but not nearly the size that we had seen over the last several years. So we have less fiscal, and we have a much tighter Fed. as a result. And the reason we have a tight Fed is because there is all of the stimulus led to inflation. And there's two things that the Fed focuses on as a mandate. They've got price stability on the inflation side, and they have to look at jobs. And well, the job market has been white hot. In fact, we have more job openings than unemployed people today. And that's one of the reasons why wages are going up, which is a good thing for the consumer, not so good for corporations, but on the cost side. But the point of it is the job side is fine. And so they can now focus on the inflation side. And the inflation side, unfortunately, is not a great picture. In fact, the most recent consumer price index report, and it's an important inflation report that we get every month, showed that gasoline fell month over month 10%. However, every other category within the CPI accelerated year over year. What are those things? Rent, food, education, medical, wages, even used car prices, all of these things accelerated. And so we saw a number of 8.3% on the headline on a year over year basis, and that's just extraordinary inflation. So that is why the Fed is trying to get ahead of the curve. Right now, I believe they're behind the curve, but they're trying to get ahead of the curve and dampen inflation. And so what this means is, there's this old adage, Steve, I know you know this, don't fight the Fed. Well, you don't fight the Fed when they're being very accommodative, because they're putting all the liquidity into the economy, and hopefully that leads to better economic growth, and that's good for earnings and good for the markets. You also don't fight the Fed when they're pulling it away, when they're becoming more restrictive. And what happened yesterday is we were expecting a hawkish Fed. Everybody thought they were going to raise rates, the Fed funds, by 75 basis points, and they did. But it was the commentary from the Fed chair that was even more hawkish. And even the projections were really pretty astounding. So they increased their target of Fed funds to 4.6%. Now that's a target, that's an average. So we don't know, are they going to go higher than that? Are they going to be able to go lower than that? We don't know, but that is an aggressive number. They also increased the unemployment rate to be 4.4% from 3.9% currently. They lowered GDP, and then they said, well, we're going to do all of this to fight inflation, but guess what? Inflation we see as being very strong above trend until 2025. And so all of this means, to wrap it up, is rates are going to be higher and they're going to be longer. And there were some people over the summer, you alluded to the nice rally we saw from the June lows to mid-August. And a lot of that was because investors thought, well, you know what, maybe we're going to get a pivot from the Fed. Maybe they've done enough and they can kind of pause and maybe even start to think about next year, they'll eventually start to ease. Well, yesterday that squashed that theory. I wasn't in that camp that they pivoted, but I certainly wasn't in the camp that they might even have to go as high as 5% in the Fed funds rate. And they believe, though, very strongly, and it was the chair Powell yesterday's comments, that they have to really be vigilant in raising rates, in keeping rates higher for longer. And as a result, you saw the markets obviously did not like it with a 500 point move lower, and we are down a little bit today. I just think this is not the end of the world, but I just think we also take a pause for a minute, right? And thankfully, your clients have you and Don and your team of amazing people to help coach them along the way, because we do have these challenging periods from time to time, but we are coming off of historically high growth rates in the last couple of years. And so this too shall pass, but we have to get through it. And I just think as a result, you're going to see this choppiness in the market in the next let's just call it 6 to 9 months, because it's just the unknowns, as I mentioned, that we don't know. The biggest one we don't know is all of these interest rate hikes. It takes 9 months to get to feel it in the economy. And so we don't know what 2023 is going to look like. And that's why you're hearing people say, we're probably going to have a recession next year because of all of these rate hikes this year. I would say it's certainly possible. The odds went up a couple of months ago that 2023 would see a recession. I do not believe we are in one right now. And the reason is because of the job market. That's kind of saving everything at this point in time. So there's a lot of puts and takes there, I know, but kind of that sets the stage as to what's going on in the marketplace and what we learned yesterday, really on a real-time basis.
Oh, I appreciate that. And I think what they kind of did is they took a lot of increases we're looking at the end of this year and the next year, and they front loaded them all.
Yes.
And that kind of brings us to the stock markets a little bit. And Don, maybe you want to touch base a little bit on US markets and global markets with stuff.
Yeah. So Stephanie, first of all, thanks for taking the time to be with us today. We appreciate that, and know your schedule's busy to say the least. As far as the markets go, looking forward through the end of the year and maybe out to next year, what is your outlook, and what does the Fed want to see? What do the markets want to see before we normalize and maybe put in a base, a bottom, and then can start to look at gains going forward?
Yeah, and it's a great question, Don. And I forgot to mention, not only are we tightening interest rates, but guess what? This week alone, we had 17 central bankers around the world tighten, and we have another dozen that meet next week. So more to come. So we had a global central bank of easing over the last 3 years, and now we're kind of reversing that. We're now seeing the global central bankers start to tighten. It's been a long time since we've seen a tightening cycle, Don, as you know, right? And there are some people that run money both on fixed income and in equities that have never seen inflation like this and haven't seen a Fed this aggressive. And so it's understandable that there's a little bit of unease. So here's what I think the Fed wants to see. They want to see substantial evidence that inflation is coming down. So they look at a lot of different inflation metrics, as you know. They look at, as I mentioned, the CPI. They look at the producer price index, that's the PPI. But then they look at this other data series called the PCE, personal consumption expenditures. It's just another fancy way of saying that's another metric of looking at inflation. And they like to strip out food and energy, which I always have an issue with that because I eat every day and I fill my tank up once a week, and it does hurt the pocketbook of a lot of people. I think it's volatile, and that's why they exclude it and they focus on the core. But it's a real issue. Those two items. But if you look at the core PCE, that's their preferred data point. So if there's anything I can just stress to anybody is that's the most important inflation metric that the Fed looks at. And right now it's running about 4.6%. And their goal is to get that down to 2%. So we have a long ways to go for inflation to come down. But I think if we start to see month over month data start to show a deceleration, I think that will go a long way. But the Chair Powell did talk a long time yesterday. He said it many different times that they're going to have to be convinced that inflation is on the way down rapidly. And so, as you know, someone said this today on TV. I don't remember who it was, but they said curbing inflation is not like turning on a light switch. It's like a dimmer. So it takes a really long time to actually control inflation. Now, we're already starting to see parts of inflation that have peaked, commodities in particular, home prices in particular, although they are still quite strong, up double digits, but they have come off quite substantially over the last several months, and that's a function of higher interest rates. And that's something that the Fed wants to see. They want to cool housing as well, right? They want to probably cool the job market, even though they're not gonna say it outright, but that's because if you cool the housing market, then maybe the wage growth that we have seen moderates a bit. And wages and rents are super important parts of inflation. They're sticky, right? Once you raise wages, it's awfully hard to actually lower them. Once you raise rents, really tough to lower them. And the interesting thing about rents is if you look at home prices, rents follow home prices on a lag by about a year. So if home prices they're coming down now, but they're still double digits and they're still quite strong, that means rents are going to stay strong. And those are the two areas I think the Fed really has to focus on, but it's not easy for them to do it without engineering a pretty big slowdown in the economy.
Yeah, those are great points. Stephanie, obviously when we go through periods like this, it's a gut check for people. It's difficult for them to keep their emotions in check, but could you speak just briefly to the importance of staying the course? And because we all know market timing is impossible. So if you could just touch on the importance of staying the course, staying invested if you're a long-term investor, and how that can benefit you in the long run.
Oh, certainly. I mean, it's funny. People say they buy low and sell high, but they don't ever buy low and sell high. They buy high and they sell low, right? Because to your point, a gut check. It's a panic. They're scared. This is real money. This is real savings. And so diversification is so incredibly important. And in these kinds of times, especially on the equity side of things, you just don't want to have these big bets. You don't want to own companies that are trading at 100 times forward earnings or that have no earnings, right? This is the kind of time, Don, that I actually try very hard to upgrade my portfolio if I can. Where can I get, when can I get the number one or number two player in an industry that's down 25% or 30% because the whole market is down 25 and 30%, save for a few outliers, right? So diversification is important. Upgrading the quality of your portfolio is important. On the fixed income side, I think now is the time to get interested, right? I mean, it had been for years, there was no alternative, but you had to be in the equity market because you weren't getting any yield in the fixed income market. And you really don't even have to go out in duration in the fixed income market to get some yield, right? So like the 10-year right now, I'm just looking at my screen, is at about 3.68% yield. The yield on the S&P 500 is 1.72. So just to compare the two, right, you could get a little bit of yield. And by the way, there's plenty of companies in the S&P 500 that have very strong yields. 3-4% is kind of the sweet spot. Anything more than 4 or 5, you start to get a little dicey, wondering if they can cover that. So you can, but you can now get yield in the fixed income market. Prices have fallen double digits, as I mentioned, and so these things are buying low and eventually selling high, hopefully in many years out and down the road. At long-term average for equities, the returns in the S&P 500 is on average 10%. So I go back to, we just saw 3 years of 28% growth in the markets on average. Now we're seeing a 20% decline. We may stay a little soft here in the short term. We might even have a crummy year next year. But history suggests that when it is declared we are in a recession, usually the market rallies because it's a known event and we're kind of like, okay, we're in it, we got it, now we can move along, right? It's like a sigh of relief. I think a lot of people thought yesterday that the chairman would be not as hawkish and that it would be a sigh of relief. Fine, we got it. We know what they're going to do, but unfortunately now he introduced more unknowns, and that's why I think we're selling off. But I think it's super important to have strong advisor teams like yourself and Steve and your team, and you guys know best what's for your clients. And this is why you meet with them all the time, and this is why you have ideas for them. And everyone is different. Everyone has a different level of pain, if you will. But hopefully, you guys can actually provide the least amount of pain for your clients.
Yeah, Stephanie. I mean, a lot of times when we talk with friends, especially the last few years, they want to talk about 3 growth stocks that have just been super strong, and we're long-term investors, we're diversified investors, and I think getting to the point of diversification, you mentioned that bonds are getting interesting now. I'd be interested a little bit in your thoughts on the asset class as far as growth in 2020 versus maybe a few years ago, because again, people like to look in the rearview mirror, not the front, and if we're looking at diversified portfolios, do we want, a lot of times clients ask us, why don't we just own large cap growth or just own 5 stocks? So I'd love your thoughts there.
Sure. Well, certainly you should not just own five stocks. That's not diversified. That definitely is not, as you very well know. Portfolios run the gamut. I have 30 stocks in my, anywhere from 30 to 40 in my portfolio. And to your point on growth, I run what they call kind of large cap, big companies, and it's core. That's the strategy. And what that means is it's a combination of growth and of value. And I can tilt or more growth if I feel like I like the growth story better, or value. This year, I'm leaning more value, because when the Fed is raising interest rates, it's very important to remember that this will hurt long duration assets, right? And because discounting the cash flows and that sort of thing. So long duration assets, what is that? That's growth, and that's mainly technology. So you want to be careful, and when the Fed is raising rates and rates are going higher, not to have too much growth. That being said, over the long run, you absolutely want to have growth. And that is because, and especially technology, and that is because there are some amazing technologies out there. These end markets are enormous. We have made tremendous strides across the gamut in AI, in cloud, in cybersecurity, in data center, in smartphones, in autos. So there's all kinds of ways to play these end markets in the technology universe. It may not feel good this year because of the dynamics, which is what is happening this year with rates. And also they do have a lot of exposure overseas, so the currency is also going to hurt them as well. So they have a couple of headwinds, but the long-term thesis and story on growth, I think, is very compelling. I think you want to couple that with some value and some, once we get through this recession, whenever it may come, if it comes, even if it doesn't, it's a slower and growth environment, then you want to own some names that benefit from the recovery, the reacceleration, or the cyclical upturn, right? And that tends to be value. What is that? That's financials, industrials, metals, materials, energy. And I think you want to definitely have some of them now, because again, when things are down, everything is down 20 to 30%, some are down even more. Well, you're able to get the best of the best right now. And I'm not saying sell everything you have and then buy everything that, buy it different. But if you had some extra money around, you should focus on, hey, can I get the #1 player in the restaurant industry, or the #1 player in the lodging industry, or the energy industry, across the spectrum. So I think that has served people well, myself included. And that's why bottom line, Steve and Don, that's why the S&P has 500 stocks in it, right? It's this diversified group of names, of opportunities. And I would simply say this one thing: in terms of the S&P 500, 35% of the weighting is in technology and communication services. Communication services used to be included in technology, as you know. They separated a couple of years ago for reasons I don't really truly understand. But if you add the two of them together, technology as a whole is 35% of the S&P 500. That tells me it's still super crowded, right? And so a lot of people like tech, a lot of people have been in the growth trade. And so that's why it's not a surprise that that sector, those two sectors, would not be doing so well this year. In addition to the rates and everything else, they got a little bit overdone. And the market has the pendulum. On the flip side, energy is only 5% of the S&P 500, and you couldn't get a growth manager to invest in energy to save your lives. It's really certainly a value sector. It's had an enormous run this year. I think if you wanted to talk about it, we could certainly at some point, but I do think that the environment from the supply side of the equation is still very attractive. And so again, a nice balance, and use the weakness in the markets to be adding to.
Good points there, Stephanie. And something else to touch on, knowing that the markets are a discounting mechanism and knowing that sentiment is negative right now, have we priced in too much bad news?
Yeah, it's a very good question, and I would say we're pricing in a heck of a lot of bad news. So on average, when you have a recession, the markets have seen a drawdown as much as 30%. So we're down 21%. So I think the risk reward from here is interesting. What is going to be difficult to assess and analyze is the timing, right? Like, what would be the catalyst to all of a sudden have sentiment change and have the markets see something different? And that's going to be dependent on inflation data as well as economic data. If we start all of a sudden seeing really big slowing growth in the economy as a whole, well, we know that the Fed then it's doing its job, what their plan of attack is. We just hope they don't overstay their welcome. And to have a 4.6% Fed funds rate from zero this year is an enormous number. And I don't want to scare anybody, but it is a shock to the system that we haven't felt just yet. And that's why people are thinking about recession. But again, to your point, down 21%, we're down a lot. Here's my other thing, my other point. What we don't know is what the slowdown is going to look like, number one, and number two, what is it going to do to earnings? Because if I can tell you nothing else other than this one thing, other than the core PCE, if I can tell you nothing else other than this one thing, you absolutely have to know stocks follow profits. When profits are rising, stocks will follow. Maybe not one for one, but they do. And the same goes on the downside. And what we don't know is all of these rate increases, how slow it's going to slow us down, how much, how fast, and what it's going to do to earnings. I think we're discounting a heck of a lot of bad news on the earnings front. I think companies, especially in the US, with their transparency, they're doing a very good job treading water at this point. They have a lot going against them. They've got higher interest rates. They can't find workers. They're paying more for workers, tons of inflation on input costs, supply chain issues. So they got a lot of things going wrong. And yet, you know what? I think that while earnings might come down for the S&P 500 and the companies as a whole, I think it's not going to be as bad as we think, because I believe our companies in the US have done a great job at restructuring, at figuring out how to increase price and productivity. And so while the demand equation might come down, the margin story might stay okay. Not great, not expansion, which is what we've seen for the last several years. But if margins kind of stay put, maybe go down a little bit, I think they'll be able to handle on the earnings front a little bit better than feared at this point.
Yeah, good. Sorry, Steve, go ahead.
No, I was going to say maybe a quick question on Hightower, because the three locations, Traverse City, Valpo, and Chicago, we all joined Hightower in 2008 and 2009. Smaller firm. We believed in the story and the growth. You joined about 2020 and really probably could go anywhere you wanted. So I'd kind of be interested in some of your thoughts on really why you chose Hightower, and maybe some of your favorite things about working within our system or working with.
Sure. I've been in the business for 30 years, and for the first 16 years, I was on the sell side of the ledger. So I was an institutional salesperson. I was a director of research. I ran the New York institutional sales desk. And what that is just I was at a few different firms. These firms, basically, they market research to people like institutions, hedge funds, mutual funds, and that sort of thing. That's called the sell side. I didn't even know what the sell side was when I graduated college, by the way. I got caught up in it, but it was a wonderful experience. I wanted to then learn how to actually be on the other side, to run money, because I enjoy it so much. And I like to learn something new every day. And I didn't know how to do that. And so I switched over to the buy side. I worked with Jim Cramer for 7 years. I worked at Nuveen for 5. But then I realized, well, it was a challenge, both parts of this business, because on the sell side, the managers didn't really want to pay for research. On the buy side, we had this passive versus active situation happening, and very challenging in terms of price compression. And so I wanted to, in kind of my last hurrah, and I hope this is my last hurrah, and I'm not even close to retiring. We don't have to worry about that. But I thought I wanted to be in an industry that was growing, that wasn't seeing price compression. I wanted to find an area within the financial services industry. And so it's a funny story, I'll tell you. I don't know if we've talked about this before, but I did some work on the independent wealth management channel. and the RIA worlds. And I did some homework on Hightower. And I had heard about Hightower over the years. It always had a very good name and reputation. And so I did a little bit of homework and I linked in to our CEO. And I said, well, hi, I'm learning about this space and I'm wondering if you might have a conversation. And I thought, oh, I'll never hear from him. You know, he's the CEO, he's so busy and whatnot. 30 minutes later, he accepted my LinkedIn invitation. And the following day, we had a nice conversation and we created this role because he said, we just don't have somebody like this for you in this role. Why did I choose Hightower over any other independent wealth management companies? Is because Hightower is the #2 player and really it's actually very close to being the #1 player. We just got ranked #2, as you know, in Barron's. And I liked that they had size and scale. And I think if you can ever find a company that you can be a part of that is growing and that actually is not only growing as a company, but growing, and then the industry is growing, that's like a double positive in my view. And then I met Bob Oros, the CEO, and he was so incredibly intelligent and heartwarming, and met some of the advisor teams and enjoyed very much meeting with I met with every team. Took me a couple of months, but met with every team, and everyone just wants to win, right? And we want to win for our clients. And I want to help you to help your clients. I want to help clients, and at the same time, I get to pick stocks and run a portfolio at the same time.
Yeah, no, it's been great. I mean, both you joining and then you've also helped attract behind the scenes some great research people as well. So I mean, some of our clients don't see that, but it's, as an advisor, it's been a great addition. So
well, thank you. I have a tremendous team too. They are really wonderful, and we have a couple of seasoned veterans that I've had to take out from retirement, which has been fun. And I have some real up and comers that are just doing tremendous work, and so it's definitely not just me; it's my whole team as well.
Well, we appreciate the time, especially being so timely right after the Fed meeting. So thank you.
Sure.
I know our clients will get a lot out of this, and have a great rest of your day.
You too. Thank you so much. Stay safe.
Thanks, Steph.
Okay. Bye-bye.
Bye.